Something important has already changed. It did not arrive with a headline. There was no emergency meeting, no official statement that said the system is under strain. But in the background, during routine government debt auctions, a quiet shift began to show itself. The numbers still cleared, the bids still came in. On paper, everything worked. That is exactly why it matters. For decades, the U.S. Treasury market operated on an assumption so basic it was rarely questioned. There would always be enough real buyers, not traders, not temporary balance sheets, but durable, long-term holders who wanted U.S. debt because it was stable, liquid, and unquestioned. That assumption no longer holds the way it used to, and the market is now adapting in ways that most people never see. This story does not begin with a collapse. It begins after something subtle already broke. Treasury auctions are supposed to be boring. They are designed that way on purpose, predictable, mechanical, routine. The U.S. government issues debt. Investors buy it. Rates adjust slightly. Life moves on. When auctions function smoothly, they disappear into the background of the financial system. But when the buyer mix changes, even if the auction succeeds, the meaning of that success quietly shifts. Old assumptions were built in a different world. In that world, foreign central banks recycled trade surpluses into treasuries without hesitation. Pension funds matched long-term liabilities with long-term government bonds. Insurance companies absorbed duration risk as a feature, not a problem. These buyers did not flinch at volatility. They did not depend on daily funding markets to hold their positions. They did not need to sell tomorrow. They anchored the system. Today, those anchors are lighter. Some foreign buyers are no longer accumulating at the same pace. Some are maintaining, not growing. Some are quietly stepping back, not because of panic, but because their incentives have changed. Pension funds face funding gaps, regulatory pressures, and demographic realities. Insurance companies are more sensitive to capital treatment and mark-to-market volatility. Central banks operate under political and reserve constraints that did not exist in prior decades. None of this creates a sudden vacuum. Instead, it creates a slow thinning of true end demand. The auction's still clear because the system has a backup mechanism. That mechanism was never meant to be the primary buyer. It was meant to be temporary. To understand what is happening now, you have to understand the role of primary dealers. Primary dealers are obligated participants. They stand between the government and the market. They bid when others hesitate. They ensure auctions do not fail. This role worked smoothly when dealers acted as intermediaries, not warehouses. They would absorb bonds briefly, then distribute them to real investors. But when distribution slows, the inventory does not disappear. It accumulates. And balance sheets are not infinite. When primary dealers take down a growing share of auctions, it does not mean demand is strong. It means the system is leaning harder on its own plumbing. Dealers finance these positions through short-term funding, repo markets, collateral chains, daily liquidity. This structure works as long as funding remains cheap, abundant, and stable. It becomes fragile when volatility rises or funding tightens. The danger is not that auctions fail outright. The danger is that success becomes conditional. Conditional on funding markets staying calm. Conditional on leverage staying cheap. Conditional on no sudden need to reduce risk. This is where old assumptions stop working. The Treasury market was never designed to depend structurally on short-term balance sheet absorption. It was designed to be owned. There is a difference. Owned assets can sit quietly through stress. Financed assets must be defended every day. The hidden mechanism most people miss is not the auction itself. It is what happens after. When a dealer absorbs treasuries, they do not simply hold them passively. They fund them. They hedge them. They manage regulatory ratios around them. Each of those steps introduces sensitivity to time. Repos roll overnight. Hedges require margin. Capital charges adjust with market conditions. This creates a system that looks stable in calm periods and tightens suddenly under pressure. The shift is subtle because no single auction looks alarming. Bid-to-cover ratios still appear acceptable. Yields move within expected ranges. Commentary focuses on inflation or rate expectations. But the composition matters more than the headline. When indirect bidders participate less aggressively, it does not make news. When dealers take down more supply, it is labeled as orderly. Orderly is not the same as healthy. It simply means the system has not yet reached its constraint. Institutions inside the system are not blind to the risk. They are trapped by it. Banks cannot easily expand balance sheets without regulatory consequences. Dealers cannot refuse auctions without destabilizing the very market they rely on. The Federal Reserve cannot permanently replace private demand without changing the nature of the market itself. Each actor has limits. The Treasury must issue. Deficits do not wait for optimal conditions. Dealers must intermediate. Their status depends on it. The Fed must balance inflation control against financial stability. Every intervention solves one problem while worsening another. This is not a story of incompetence. It is a story of constraint. Time plays a quiet but central role. Treasury issuance is not slowing in a meaningful way. Maturities roll, deficits compound. Refinancing continues regardless of market sentiment. Supply is not optional. Demand, however, is conditional. When true long-term demand does not grow with supply, the gap must be filled. For now, it is filled by balance sheets and funding markets. That works until it doesn't. The pressure does not build linearly. It builds invisibly, a little more inventory here, a little more repo dependence there, a slightly thinner margin for error. Nothing breaks on a good day. The risk appears on a bad one. A sudden spike in volatility, a funding squeeze, a regulatory change, an external shock that forces risk reduction. In those moments, the question is not whether treasuries are safe. The question is who is able to hold them without selling. When holders are leveraged intermediaries instead of end investors, the answer changes. This is why the buyer crisis is quiet. It is not about confidence in the United States. It is about capacity. Capacity to absorb growing supply without stress, capacity to finance inventory without disruption, capacity to maintain liquidity under pressure. Markets often fail at the margins first. Bid-ask spreads widen slightly. Repo rates jump briefly. Dealers pull back from making tight markets. These are not dramatic events. They are signals. Signals that the system is using more effort to achieve the same result. That effort is not free. It consumes balance sheet, it consumes liquidity, it consumes time. The longer this structure persists, the more sensitive it becomes to interruption. There is no clear resolution built into the system. Foreign buyers may return, or they may not. Domestic institutions may increase allocation, or they may be constrained. The Fed may intervene, or it may hesitate. Each option carries cost. The system continues forward because it must, not because it is comfortable. At some point, the difference between ownership and financing becomes impossible to ignore, and by the time it is visible to everyone, the adjustment is no longer gentle. This is not a prediction of collapse. It is an explanation of fragility. A market can function for a long time while growing weaker beneath the surface. The auctions will likely keep clearing. The headlines will remain calm until the day they don't, and when that day comes, the problem will not be a lack of buyers. It will be the realization that the buyers were never what they used to be. The distinction matters because systems fail differently depending on who holds the risk. When long-term investors hold treasuries, stress is absorbed quietly. Prices move, but positions remain. Time works in the system's favor. When intermediaries hold treasuries, stress compresses time. Decisions are forced faster. Funding must be renewed. Margins must be met. The market becomes reactive instead of absorptive. This change does not announce itself. It shows up as subtle behavior. Dealers become more selective about maturities. Liquidity concentrates in the most recently issued bonds. Older issues trade less frequently with wider spreads. This is not disorder. It is prioritization. Balance sheets are finite. They are optimized continuously. The Treasury market has grown too large to rely on habit alone. Issuance today is not just higher in nominal terms. It is structurally higher relative to natural demand growth. Deficits compound. Interest costs compound. Refinancing cycles accelerate. Each auction is connected to the last. The system can handle size. What it struggles with is pace. Supply arrives on a calendar. Demand arrives conditionally. When those two rhythms diverge, pressure builds. The Federal Reserve sits uncomfortably in the middle of this. Officially, it is not a buyer in routine auctions. Unofficially, it remains the backstop everyone prices around. Markets assume that dysfunction will be addressed. They always have. But assumption is not a mechanism. The Fed cannot absorb unlimited supply without consequences. It cannot expand its balance sheet indefinitely without political and inflationary implications. It cannot withdraw support too aggressively without destabilizing funding markets. This creates a narrow corridor. Within that corridor, primary dealers do more work. Outside of it, something breaks. The danger is not sudden abandonment. It is gradual dependence. As the system leans more heavily on intermediaries, the cost of intervention rises. Each rescue sets a precedent. Each adjustment trains behavior. Market participants adapt rationally. If holding treasuries requires more balance sheet, fewer will volunteer. If making markets carries higher regulatory costs, liquidity will thin. If funding becomes less predictable, risk will be reduced preemptively. None of this is malicious. It is mechanical. Regulation matters here. Post-crisis capital rules were designed to make banks safer. They succeeded in many ways. They also made balance sheets expensive. Treasuries are low-risk assets, but they are not balance sheet free. They consume leverage ratios. They interact with liquidity coverage requirements. They complicate stress tests. Holding more treasuries is not neutral for a bank. It is a choice with trade-offs. When issuance rises faster than balance sheet tolerance, the system adapts by shortening holding periods. Assets move faster. Funding rolls more frequently. Stability becomes procedural rather than structural. This is why liquidity can disappear without warning. On normal days, markets feel deep. On stressed days, they reveal how shallow they have become. The Treasury market has experienced moments like this before. They tend to be explained away afterward as anomalies, a technical glitch, a temporary dislocation, an unusual confluence of events. But patterns repeat for a reason. Each episode leaves behind small changes. More rules, more caution, more sensitivity. The buyer crisis is not about trust in the U.S. government's ability to pay. It is about the willingness and ability of institutions to intermediate endlessly. That willingness is not infinite. As supply grows, the system relies more heavily on confidence in process. Confidence that auctions will clear. Confidence that funding will roll. Confidence that someone else will take the other side later. Confidence is powerful. It is also fragile. It does not need to disappear entirely to cause disruption. It only needs to thin. When confidence thins, margins widen. When margins widen, leverage falls. When leverage falls, capacity shrinks. This feedback loop does not require panic. It only requires caution. Caution is rational. It is contagious. A dealer who reduces inventory slightly is acting prudently. If many dealers do the same, liquidity evaporates. The system does not break evenly. It breaks where flexibility was assumed. Short-term funding markets feel stress first, then off-the-run bonds, then broader liquidity. By the time retail investors notice, institutions have already adjusted. This is why the shift remains invisible. Treasury auctions still clear, rates still trade, commentators still focus on inflation prints and policy meetings. The deeper story unfolds quietly in allocation decisions and balance sheet meetings. Who wants to hold this? For how long? At what cost? Those questions used to have easy answers. They do not anymore. There is a temptation to believe that size alone guarantees safety, that the largest market must be the most liquid, that scale solves fragility. Sometimes scale magnifies it. A small imbalance in a large system produces large consequences. The Treasury market is not just a market. It is collateral. It is reference pricing. It is the foundation of leverage across the financial system. Changes here propagate outward. When dealers carry more inventory, repo markets become more important. When repo markets tighten, funding costs rise. When funding costs rise, risk assets feel pressure. The connection is indirect but real. This is how stress moves without headlines. There's no villain in this story. There's only arithmetic. More supply, limited balance sheet, finite time. Institutions respond logically. The system responds mechanically. The outcome emerges slowly. The most dangerous moment is not when something breaks. It is when everyone believes nothing will. By the time the buyer problem becomes obvious, the system is already adjusting under stress. An adjustment under stress is never smooth. This is not a call for alarm. It is a recognition of structure. Treasury auctions are doing their job. The question is, how much hidden work is required to keep them doing it? That work is increasing, quietly, relentlessly. And it is happening whether anyone is paying attention or not. The strain does not show up where people expect it. It does not appear as a failed auction. It does not arrive as a sudden spike in yields that refuses to come back down. It does not announce itself through a formal warning. It appears as hesitation. Hesitation to warehouse risk, hesitation to make tight markets, hesitation to assume that liquidity tomorrow will look like liquidity today. Those hesitations are invisible in aggregate data. They are visible only inside institutions, in internal limits, in risk committee decisions, in balance sheet usage reports that never become public. This is where the real shift is happening. Every large dealer tracks how much of its balance sheet is committed to treasuries, not just in absolute terms, but relative to everything else it could be doing. Each additional dollar allocated to government debt is a dollar not used elsewhere. In a system with rising capital costs, that trade-off matters. What used to be unquestioned now competes. The Treasury market is no longer competing only with other safe assets. It is competing with flexibility. Flexibility has value. Assets that tie up balance sheet for long periods are less attractive than those that can be moved quickly. Assets that require daily funding carry a different kind of risk than assets that can simply be held. The shift toward dealer absorption increases the system's reliance on speed. Speed of funding, speed of hedging, speed of response. Speed creates efficiency in calm conditions. It creates fragility under stress. This is the paradox at the center of the buyer problem. The market appears deeper than ever until it needs to be. Then it reveals how much of that depth was conditional. Consider how modern Treasury trading actually works. A large portion of activity is now intermediated through high-speed platforms. Positions are turned over rapidly. Inventories are optimized intraday. This structure delivers tight pricing in normal conditions. It also assumes that someone is always willing to intermediate. When true end holders dominate, this assumption is reasonable. When intermediaries dominate, it becomes circular. Everyone expects everyone else to provide liquidity. That expectation holds until it doesn't. When volatility rises, the first response is not panic, it is caution. Quotes widen slightly, size offered shrinks, inventory targets are lowered. None of this triggers alarms, but together they change the character of the market. Liquidity becomes selective. It exists at certain prices, for certain sizes, at certain times. That is not failure, it is adaptation. The problem is that the Treasury market is treated as if adaptation is unnecessary. It is assumed to be infinitely liquid because it always has been. That assumption was built in an era when the buyer base was fundamentally different. Foreign central banks once absorbed large quantities without concern for daily price movement. Domestic institutions once treated treasuries as permanent holdings. Those roles have diminished, not disappeared, diminished. What replaced them is not ownership, it is circulation. Assets move faster. Risk is redistributed more frequently. Exposure is managed more actively. This is efficient in theory. In practice, it reduces tolerance for surprise. The system becomes more sensitive to timing. Auctions are scheduled, funding is rolled. Regulatory ratios are calculated at specific intervals. When stress aligns with those schedules, pressure concentrates. This is why past episodes of Treasury market stress often seem sudden. They are not sudden. They are the release of pressure that built quietly over time. Each new issuance cycle adds weight. Each refinancing adds dependency. Each marginal shift in buyer composition adds sensitivity. There is no single point of failure. There is only accumulation. The Federal Reserve understands this dynamic. That is why it monitors market functioning as closely as it does inflation. That is why it maintains facilities that are rarely used but always referenced. That is why language around orderly markets matters so much. Orderly does not mean strong. It means contained. Containment requires credibility. Credibility requires capacity. Capacity is finite. This is the limit the system is approaching. Not a legal limit, not a policy limit, a practical one. How much inventory can be absorbed without distortion? How much funding can be rolled without stress? How much balance sheet can be committed without crowding out everything else? These questions do not have public answers. They are tested in real time, quietly. Most participants behave as if the future will resemble the recent past. That is reasonable. It is also dangerous when structure has already shifted. The buyer crisis is not about tomorrow's auction. It is about the accumulation of obligations that extend far beyond any single event. Debt that must be issued, debt that must be rolled, debt that must be absorbed. The system can manage this for a long time, longer than most people expect. That is what makes recognition so late. When the adjustment finally becomes visible, it will not look like a single cause. It will look like a series of unrelated frictions. A funding hiccup here, a liquidity gap there, an intervention that feels technical rather than dramatic. By the time those pieces are connected, behavior has already changed. Markets do not wait for explanations. They respond to constraints. The quiet buyer crisis is not a forecast. It is a description of the present tense, a system still functioning, still clearing, still trusted, but doing more work with less margin, and systems operating that way rarely fail loudly at first. They strain, they adapt, they narrow, until one day the effort required to keep everything normal becomes visible. Not because something collapsed, but because something finally refused to stretch further. And when that moment arrives, it will not feel like a surprise. It will feel like recognition arriving late, after the shift has already done its work.